Bitcoin is at $77,000, not $80,000, not $65,000. $77,000, give or take the daily gyration. And if you have been watching financial markets, you might be wondering how that is possible. Because by conventional logic, Bitcoin should be getting hammered right now. You have a hawkish Fed, high interest rates, global macro uncertainty, oil at 126, an internal institutional crisis at the world's most important central bank. These are not conditions that historically produce asset price rallies. These are conditions that historically produce risk-off behavior, where investors flee toward safety and away from speculative assets. And yet here Bitcoin sits, not crashing, not imploding, not revisiting $40,000 or $50,000, consolidating, holding, stubbornly refusing to do what conventional macro logic says it should do. Why? The answer is sitting in a data set that not enough people are paying attention to. Bitcoin exchange reserves, the amount of Bitcoin sitting on centralized exchanges and therefore available to be sold, are at a 7-year low, 7 years. We have not seen this little Bitcoin available for sale on exchanges since 2019, when the total market cap of the entire cryptocurrency ecosystem was a fraction of what it is today. Think about what this means in terms of simple supply and demand mechanics. If I am trying to understand why an asset's price is not falling even in an adverse macro environment, I look at the supply side. Is there a lot of the asset available to be sold? Are holders selling? If the answer is no, if supply is constrained, then even modest demand can support prices at elevated levels. There simply is not enough Bitcoin on exchanges to be sold into a crash. But where is all the Bitcoin? It is not on exchanges, which means it is in cold storage. It is in custodial wallets. It is in the vaults, metaphorical and literal, of institutional holders who bought it with a long time horizon and have no intention of selling it at these prices. And a significant portion of it is sitting with names you will recognize. BlackRock's Bitcoin ETF, iShares Bitcoin Trust, has continued to accumulate. Fidelity's Wise Origin Bitcoin Fund has continued to accumulate. And these are not momentum traders. These are the largest asset managers on earth who made a deliberate institutional decision to gain Bitcoin exposure on behalf of their clients, who filed the regulatory paperwork, who built the custody infrastructure, and who are not going to panic sell because Jerome Powell is hawkish. They were buying Bitcoin when Jerome Powell was hawkish. They bought it when he was raising rates. They are not going to sell it because he kept them high for longer. This is the structural shift that changes the old Bitcoin playbook permanently. The old Bitcoin from 2013, from 2017, even from 2021, was dominated by retail holders, by enthusiasts, by people who bought on emotion and sold on emotion. Those holders are still here, but they are now a smaller percentage of the overall market than at any previous point in Bitcoin's history. The marginal holder of Bitcoin today is increasingly an institution with a long-time horizon, a fiduciary obligation to its clients, and a very different tolerance for short-term price volatility. When institutions hoarded gold in the 1970s during a period of monetary instability, gold did not go down. It went up, dramatically, famously, precisely because the fundamental case for owning an asset outside the control of any central bank got stronger as central bank credibility eroded. Bitcoin is making the same argument to the same institutional buyers, but in a world where those buyers have ETF infrastructure, regulatory clarity, and 24/7 liquid markets. The supply inelasticity, 7-year low exchange reserves, means that even in the face of Powell's hawkish hold, there is not enough Bitcoin available to sell for the price to collapse. It would require a mass exodus of institutional holders from their cold storage positions, and nothing in the current environment incentivizes that behavior. But here's the thing about $77,000. It is not just a price. It is a statement. It is the market saying, we see the macro risk, we see the oil, we see the Fed split, we see the uncertainty, and we are pricing this asset as a hedge against exactly that uncertainty, not as a speculative bet on everything going well, but as insurance against everything going wrong. When fiat currency credibility is under pressure, when a central bank is visibly politically fractured, when the reserve currency is being weaponized in geopolitical disputes, when oil shocks are threatening stagflation, Bitcoin's value proposition does not weaken, it strengthens. Every piece of bad macro news that would crash a growth stock or a speculative tech company is, for Bitcoin, an argument for why an asset with no central bank, no political allegiance, and a fixed supply schedule deserves a place in a serious portfolio.